Hello there. Today is Tuesday, May 13th, and welcome to the latest edition of the Kluge Wealth Advisor Group Client Connect video. In this video, we're going to discuss some portfolio changes that we made over the last few weeks, what's happened in the market since our last video, as well as touch on a number of frequently asked questions that we've encountered over the course of our client conversations in the last couple of weeks. So we have a little bit to get through here, so let's jump right into it. As we are approaching mid-quarter, we are conducting our usual customary portfolio review of all holdings. So as a result of that review, there's a number of changes that have happened and a couple of more changes that we'll inform you of as they take effect. As it stands right now, we've made a few changes to the equity portfolio. We've eliminated our position in Apple and in Google and replaced the position in Apple with a position in Palantir and Walmart, and replaced the position in Google with a position in Netflix. Now, the rationale for these changes really comes down to the fact that both Google and Apple had not really shown strong recoveries off the April 8th bottom. When you have a correction like we had recently, stocks that tend not to bounce with the rest of the market usually don't end up performing well as we go forward. Now, of course, these two could be exceptions. However, going on track record and experience tells me that it's time to replace those names and find new names that have a better chance of working better. We also made one other change for tax purposes. We removed a position in a high dividend, low volatility factor ETF in the US dollarized accounts and replaced it with a low volatility factor ETF. Similar in strategy, however different enough that will allow us to realize the tax loss that existed there and to help defer or defray some of the capital gains tax bills that we'll be looking at for next year. So if you have any questions on that or would like to get deeper into any of the rationales or any of the discussion around those trades, happy to do so, but let's get moving on to our next segment. In terms of developments since our last video, there's a number of important ones that I want to make sure we take a few moments here to discuss. The first, which is the most recent news, which came out this morning here on Tuesday, May 13th, was the appointment of a new cabinet by our new Prime Minister, Mark Carney. Now, depending on the way in which you want to look at some of the appointments, you could either interpret this as a pro-business cabinet or a continuation of Mr. Trudeau's policies. However, I think what we really need to do here is to take a step back and wait until Parliament sits and to see what actual sorts of legislation come through. Because at the end of the day, proof is going to be in action. So let's see what the actions are, and before then, let's not jump to any conclusions, whether they be positive or negative. Another key development that we've seen over the last couple of weeks have been a number of trade deals. We had what I would classify as a mini trade deal with the UK, between the US and the UK, as well as a constructive series of talks between the US and China. This has helped lower trade tensions, and that in turn has helped to make markets perform much better than they were previously. If we take a look at market performance over the last couple of weeks, it's been very, very strong. Now, some of that is, of course, attributable to the decrease in trade tensions, but some of that is, of course, attributable to earnings. And over the last couple of weeks, we've seen corporate earnings come out that are surprisingly strong. Now, in some respects, this surprise shouldn't be that surprising. Companies have had to deal with an enormous number of things over the last 5 years, and they've gotten very, very good at managing their earnings, managing their supply chains, and managing their businesses through all sorts of unexpected events. So for battle-hardened companies with experienced management teams, this was another challenge that we faced. And another important point we do want to also bring out is that the most recent US inflation data, which includes the month of April, which has tariffs in it, showed a decrease in the rate of inflation overall. Inflation came in below expectations and certainly in a constructive range. Now, it could be that the impact of tariffs on inflation is delayed and we'll see it in future months, but any good data on inflation is just good data. So we'll take that where we can get it. Now, let's move on to some of our frequently asked questions. In terms of talking about the frequently asked questions that we saw in our client conversations over the last couple of weeks, we're going to break this up into two segments. The first segment is going to be a rapid fire segment that gives a bottom line answer to each of the 4 key questions that we've identified here. And the second segment is going to go into a little bit more detail on questions 3 and questions 4. All right, let's get started with the rapid fire answers to some of the questions we saw. Now, there were 4 questions that came up pretty frequently over the course of client conversations, and they surrounded Bitcoin, what is the Trump agenda, what is the outlook for Tesla, as well as what is the outlook for interest rates. So as best as I can make out, here are the answers we can give. In terms of Bitcoin, we are still firmly in the halving cycle and demand for Bitcoin looks strong. So the most normal thing that would happen in that situation is that the price of Bitcoin should continue to appreciate, and we would at some point again continue to trim back the position to take profit as we do off all successful positions. In terms of the Trump agenda, that really comes down to 3 items. It's going to be trade reform, tax reform, and deregulation. Now we can go into depth on each of those 3, and we'll go into a bit more depth in the next segment, but that's what it comes down to. In terms of Tesla, again, the outlook, Tesla it has been a more volatile name, is one that has appreciated rapidly. We trimmed it, and then it had, of course, slumped during the February to April correction, and then it's also rapidly appreciated again. So I really want to emphasize that we're not looking at Tesla like a car company. We are looking at it like an autonomy company and an AI company. The car business is really incidental, and if it's successful, that's great. But really what Tesla needs to survive, thrive, and be a leader is they need to maintain their lead in self-driving as well as in other types of robotics. And that's why we own the company, is for the AI and robotics businesses, not for the car company. Now, in terms of the outlook for interest rates, I think given what's happened and given that we are entering a economic soft patch, not a recession, but a soft patch, the most normal thing is we're going to continue to see interest rates fall. Now, we have seen interest rates fall in Switzerland, in Europe, in Canada, in China. And so the most normal thing is that you'd expect global rates to continue to fall further as the economy slows down and adjusts to the new trade regime that the Trump administration is pushing for. So that's the bottom line answers to some of the questions we've seen. In our next video, we're going to touch a little bit more in depth on the Trump agenda as well as the interest rate question. Thank you very much. So touching on things in a little bit more depth here, let's start out with talking about the question about what is the Trump agenda and what's driving it. Now, before I speak about anything in regards to President Trump, I always want to reiterate the fact is I'm simply trying to provide observation, not opinion. Now, in terms of the Trump agenda, we know it's centered around deregulation, trade reform, and tax reform. And in the words of Secretary of the Treasury, Scott Bessent, right, that is to drive AI dominance, productivity growth, and the reshoring of critical supply chains. Now, of those 3, I think the most important one, where we do need to focus on, is on the productivity portion. Now, the reason why productivity is so important is the US does need to be able to grow its way out of its debt. And I think ultimately, when we take a look at the analysis, the direction we're trying to get to in terms of Trump policy is we end up with a group of macroeconomic policies that are going to reproduce the conditions that we saw post-World War II. And those critical conditions that we saw post-World War II, which allowed the US to get its way out of debt from World War II, was that nominal GDP was greater than inflation, which means that the economy is growing in real terms and that ultimately the tax revenue is going up and deficits are shrinking. The other thing we saw was that inflation was greater than nominal interest rates. So what that means is that there was a tax on savers in that situation. Inflation, we were inflating away part of the debt. So really what they're trying to drive ultimately is a situation where you're both simultaneously growing out of and inflating away debt. And over a decade and a half to 2 decades, that will likely provide a solution that allows the US federal government to move its debt to GDP ratio to a more sustainable basis. Now, again, this is just an observation. However, it seems to line up with the current trends and the current policy push. However, again, this video may or may not age well, but we'll let future historians decide that one. The second question we wanted to address in a little bit more depth is around the future path of interest rates. We know recently that the US Federal Reserve chose to pause and not to cut interest rates. However, the US Federal Reserve really at this point is an outlier in terms of world central banks. We are seeing the central bank of the Eurozone cut interest rates. We are seeing the Chinese central bank cut rates and inject liquidity. Central banks in Canada, Switzerland, etc., etc., etc. So what we're seeing is a global loosening of monetary policy with or without the Fed's participation. And I think this really does make sense. We do need to get interest rates down because the amount of debt in the world makes high interest rates unsustainable. And in the short term, we are facing some disruptions from the Trump agenda in terms of the trade reorganization they're attempting to affect. So although I personally do not believe we're going to see a recession come from this, we are definitely going to get a growth slowdown, and that growth slowdown is going to ultimately lead to lower rates. So again, as far as we can tell, one would expect that interest rates should continue to march down, and we should also frankly expect inflation to be marching down at the same time. So, of course, if you have any questions on this or anything else, we'd be happy to get into a little bit more depth on this or other factors. Thank you. So in terms of wrapping up this video, we discussed a number of things. We had a recap of things that have happened in the markets and in headlines. We talked about some portfolio changes that happened, and then we dealt with 4 questions in terms of Bitcoin, Tesla, the Trump agenda, and what it looks like the likely forward path of interest rates in both in Canada and globally. So I'd like to reemphasize that if you have any questions or is there anything that you would like to address in your own personal financial situations, please pick up the phone, book us on Calendly, email, and very soon we'll be able to use text message. So we're here, and let us know what's on your mind, and we're here to help. Thank you.